Welcome back to another edition of The Deep Dive. It is great to have you with us.
I was thinking about how we usually start these conversations. We spend so much time looking at the dashboard of the car,
Right.
right? We talk about the speedometer. Is the market going up or down?
The fuel gauge, what's the volume?
We analyze the GPS, where the trend's heading. We are, we're obsessed with the destination.
That's where the excitement usually is. Everyone wants to know where the car's going and how fast it can get there. It's just human nature to focus on the outcome, not the process.
Exactly. But today, we are doing something a little different. Today, we are popping the hood.
Right.
We are looking at the engine block. We are looking at the transmission. We're asking a question that I think most traders, even experienced ones, rarely stop to ask. When I tap that blue buy button on my phone screen, what actually happens?
It is the million-dollar question. Or in the case of the Indian derivatives market, the multi-trillion-dollar question. Right, because in that split second between my finger lifting off the screen and the order executed notification popping up, there is an entire universe of infrastructure, of physics, regulations, and mathematics that just fires off. It feels instant, but it's incredibly complex.
It's like flipping a light switch. You expect the light to turn on instantly. You don't think about the copper wiring, the substation, the transformer, the power plant.
The coal being burned.
All of it. The grid load management. But in financial markets, that grid is what keeps the whole thing from collapsing. If the grid fails, the price on your screen is, well, it's meaningless.
And that grid is the focus of our source material today. We are dissecting Chapter 6 of the NISM Series 8 Equity Derivatives Workbook. The title is Trading Mechanism. Now, I'll be honest, when I first saw that title, I thought, okay, this might be a bit dry.
A little technical, maybe?
Yeah. This is going to be about server racks and cables and maybe some boring compliance rules.
Did it live up to that expectation?
I was so wrong. I mean, yes, it's about the system, but as I read through it, I realized it's really a story about fairness. It's a story about speed. And it's a story about how we moved from guys screaming at each other in sweaty pits to algorithms fighting for position in nanoseconds. It's actually pretty dramatic when you peel back the layers.
That is the perfect way to frame it. This chapter isn't just a technical manual. It is the story of the transition from the open outcry system, the physical pit, to the digital pit. And the stakes couldn't be higher.
Right.
We aren't just talking about connecting a buyer and a seller. We are talking about risk management, disaster recovery, mathematical fairness during corporate actions, and preventing what they call fat finger errors that could wipe out a brokerage in seconds.
So here is our mission for this deep dive. We're going to unpack this invisible engine. We're going to break it down into pieces. First, we need to understand the machine itself, the electronic matching system. How does it decide who gets the trade? Because if I bid 100 and you bid 100, who wins?
The algorithm of matching. It's the logic of the auction. We will definitely get deep into that.
Then we're going to look at the VIP list. I didn't realize this, but not every stock gets to be a derivative, right? Oh, there is a bouncer at the door.
A very, very strict bouncer. We'll look at the eligibility criteria, why some stocks get futures contracts and others are just, left out in the cold. It's not random. It's all about safety.
We'll also tackle the math of fairness. This is the part that always confuses me. If a company splits its stock or gives a dividend, what happens to my options? Do I just lose money?
Nope. We will crunch the numbers on that. It's all about keeping the universe balanced.
And finally, we have to talk about the rise of the machines, algorithmic trading, the cost of speed, and what happens when the system crashes. Because, as we know, technology is great.
Until it isn't.
Exactly.
And when it isn't, you need a safety net. We'll cover that too.
So, buckle up. We are going deep into the plumbing of the market. Let's start with the basics, the digital pit.
Let's do it.
Help us visualize this transition first. We've all seen the movies. Trading places, the Wolf of Wall Street. You picture a trading floor, it's just chaos.
Complete chaos.
People are wearing colorful jackets, waving their hands, shouting, buy, sell, holding up fingers to signal price. It looks like a riot.
The open outcry era, it was visceral. It was physical. You had to be loud. You had to be aggressive. If you were short and quiet, you literally might not get your trade filled.
Wow.
But it's also incredibly inefficient and prone to errors. Misunderstandings happened all the time.
And limited, right. You had to physically be there. If I was sitting in a small town, I couldn't participate directly.
Exactly. The source material describes the shift from that to the NEAT system. That's the National Exchange for Automated Trading. Today, the floor is a server room. It's silent, it's cold, and it's unbelievably fast.
A completely different world.
And the market type itself has shifted from, quote, driven to order-driven.
Pause there for a second. That's a key distinction in the text. Order-driven versus, quote, driven. I think a lot of people hear those terms and their eyes just glaze over. What is the actual difference?
Okay, let's break it down. Imagine a traditional vegetable market. You walk in, and there are 5 vendors. Each vendor has a sign-up. Potatoes. Buy at 20, sell at 22.
Got it.
Those vendors are market makers. They set the quotes. If you want potatoes, you have to deal with their price. You can try to haggle, but ultimately they control the spread. That is a, quote, driven market.
Okay, so the intermediary sets the price. The liquidity really depends on them.
Right. But the Indian derivatives market, NSE and BSE, is an order-driven market. In this system, there are no designated market makers setting the price. Instead, everyone, you, me, the big banks, the foreign investors, we all throw our orders into a central pot.
The order book.
Correct. The system displays all the buy orders and all the sell orders transparently. The price isn't set by a person. It is discovered by the interaction of all those orders.
So it's pure supply and demand.
If you want to buy at 100 and I want to sell at 100, the trade happens. The market price is just the last price where a buyer and seller agreed.
So it's a pure auction.
It is a continuous, high-speed, anonymous auction. And anonymous is the key word here. When you buy nifty futures, you don't know if you bought them from a hedge fund, a dentist in Mumbai, or an algorithm in New York.
The system doesn't care.
It blinds the identity. It only cares about the order parameters, price and quantity.
That feels much fairer. It really levels the playing field, doesn't it?
It does.
But wait, I can't just log into the NSE server and start typing numbers. I need access. I need a badge, so to speak.
No, you can't just walk in.
Yeah.
That brings us to the entities, the gatekeepers. You have to go through members.
The text lists a few types. We have the trading members, or TMs. These are the brokers we know, right? Zeroda, Angel One, ICICI Direct.
Correct. The trading member is your interface. They have the license to push buttons on the exchange. They're the ones who have passed the exams, pay the deposits, and have the infrastructure to connect. But there is a layer behind them that is even more critical and often invisible to the retail trader, the clearing member, or CM.
I've always found this distinction a bit blurry. What is the real difference between executing a trade and clearing a trade?
Think of it like a fine dining restaurant. The trading member is the waiter. They take your order to the kitchen. They make sure you get your food. They're customer-facing.
Okay.
But the clearing member, they are the cashier and the bouncer combined.
The cashier and the bouncer. I like that.
They make sure you actually have the money to pay for the meal. And if you try to order 5 lobsters when you only have money for a salad, they stop you. The clearing member is responsible for settling the trade, handling the money, and, most importantly, the risk.
So the clearing member handles the funds and the settlement.
And the risk. This is crucial. If a trading member goes bust, if they allow a client to make massive bad bets that they can't pay for, it's the clearing member's responsibility to make the exchange whole. That's why not every broker clears their own trades.
Really? I just assumed if I trade with a broker, they handle everything from end to end.
Not always. You have self-clearing members, SCMs, who clear their own trades. These are usually the larger brokers. But you also have smaller brokers who are just trading members. They execute the trade, but they hire a professional clearing member, a PCM, to handle the back end.
A PCM. And who are they usually?
Usually big banks or custodians.
Yeah.
Deutsche Bank, HDFC Bank, folks like that. They don't trade. They don't take positions. They just process the risk and money for other trading members.
So it's a safety mechanism.
It is. It segregates the casino side, which is the trading, from the bank side, the clearing. If the casino goes bust, the bank is still there to ensure the winners get paid.
That makes a lot of sense. It compartmentalizes a disaster. Now, speaking of disaster prevention, the text outlines a hierarchy within a brokerage firm. It seems very, very military.
It has to be. Imagine a brokerage firm with 500 dealers sitting at terminals. If one dealer goes rogue, maybe he's having a bad day, or he thinks he has a sure thing, and starts betting the house on a losing trade, he could bankrupt the entire firm in minutes. We've seen this happen in history. Barings Bank collapsed because of one rogue trader.
Right.
So the NISM workbook defines a strict user hierarchy to prevent this.
Let's walk through the ranks. At the top, we have the corporate manager.
The boss mode. The corporate manager has the God view. They can see everything, all the branches, all the dealers. They set the limits. They can say, okay, the Delhi branch can only trade up to 100 crores today. The Mumbai branch gets 200 crores. They manage the aggregate risk.
And below them?
The branch manager. They oversee a specific division or location. They can view and control the dealers under them, but they can't see what the other branches are doing. They're in their own silo.
And at the bottom, the foot soldiers, you have the dealers.
Yes. A dealer can only see and manage their own orders. They're totally siloed. This ensures that a problem in one seat doesn't infect the whole system.
So if a dealer starts hitting their limit,
The system locks them out. They have to call the branch manager or corporate manager to get an extension. It adds friction to prevent impulsive, catastrophic errors.
it's basically a series of till switches.
Exactly. It safeguards the firm from its own employees.
Okay, so we have the players and we have the hierarchy. Now let's get into the action. I want to talk about the algorithm of matching.
The logic of the engine. The secret sauce.
This is something I think frustrates new traders. You place an order and it doesn't get filled, or it gets filled partially. Let's break down exactly how the computer decides who gets the trade. The text calls it price time priority.
It's a two-step logic. It's actually very elegant in its simplicity. Step 1. Price is king. Step 2. Time is queen.
Unpack that. Price first.
The system is designed to reward the most aggressive trader. If you are a buyer, aggressive means you are willing to pay more. If you are a seller, aggressive means you are willing to accept less.
Okay. Example time. Let's say the current market price for a stock is 100. I put in a buy order at 100. You put in a buy order at 101.
I win. Instantly. Because I am offering a better price to the seller. The system sees my 101 and puts me at the very front of the line, ahead of everyone bidding 100.
Even if I was there first.
Doesn't matter if you placed your order an hour ago. My price is better, so I cut the line.
That's fair. Money talks. But what happens in the real world where everyone is looking at the same screen? Let's say the price is 100, I bid 100, you bid 100, 10,000 other people bid 100. Who gets the shares?
That is where time priority kicks in. If the prices are identical, the system looks at the timestamp of when the order hit the exchange server, and we are talking down to the microsecond.
So it's first come, first served?
Precisely. It's exactly like a queue at a ticket counter for a rock concert. If we're all willing to pay the same price for the ticket, the person who got in line first gets it.
And this explains why speed is such a big deal, doesn't it?
It is the only reason high-frequency trading exists. If I can get my order to the exchange server 5 microseconds faster than you, I am ahead of you in the queue. If there's only one seller, I get the trade, and you get nothing.
So when we see those bid and ask quantities on our screen, that's actually a queue.
It's a stack. A very long, very fast-moving stack. And your order is just one brick in that stack.
Now here's a scenario. What happens if I change my order? Say I've been waiting in line at Rs 100 for 10 minutes. I'm at the front. But I decide, you know what? I want to buy 500 shares instead of 100. I edit the order. Do I keep my place in line?
The modification trap. No. Generally, if you increase the quantity or change the price, you lose your time priority.
Oh, no.
Go to the back of the line.
Ouch. So I step out of line to grab more cash and I have to start over.
Exactly. The system treats it as a new order.
Yeah.
However, if you decrease the quantity, say you only want 50 shares instead of 100, you usually keep your timestamp.
Why is that?
You're asking for less, so the system doesn't penalize you for it.
That is a very, very useful tip. Don't increase your size if you want to keep your priority.
Right. It's a rookie mistake.
This is a perfect segue into talking about the orders themselves. We know the matching logic, but we need to speak the language of the machine. The text covers the standard ones, market and limit, but also some specific conditions that I think confuse people.
The order types. This is your control panel. This is how you tell the engine what to do.
Let's start with the classic dilemma, limit versus market. I always think of market orders as the panic button.
Or the I don't care button. A market order says, execution is my priority. Price is secondary. You're telling the system to buy the stock now at whatever the lowest available selling price is.
Which is fine if the market is calm.
Right. If the market is stable, you'll get a price very close to the last traded price. But if the market is volatile, that is dangerous. Imagine you place a market order to buy. The best seller is at 100, but he only has one share. The next seller is at 105. The next is at 110.
And I ordered 1,000 shares.
Your market order will squeak through the book. You'll buy the one share at a 100, then you'll buy at 105, 110. Your average price might be 108. You just paid an 8% premium instantly because you didn't use a limit order.
That's slippage.
That is classic slippage.
So the limit order is the disciplined approach.
A limit order says, price is my priority, execution is secondary. You say buy at 100. If the price is 100.05, You don't trade. You sit there and wait.
You could miss the trade.
You might miss the trade entirely if the price runs away, but you will never pay more than you agreed to. It protects you from bad fills.
Now, let's talk about the safety net, the stop loss. I feel like this is the most misunderstood order type. People think it's just a sell button that triggers automatically, but the mechanics are specific.
It's a bit more mechanical than that. A stop-loss order is actually dormant. It's asleep. The market doesn't even see it in the order book.
Explain the anatomy. It has two prices, right? A trigger price and a limit price.
Correct. Let's build a scenario. You bought a stock at 100. You want to limit your loss to 5 rupees. So you set a stop loss. You set the trigger price at 95. As long as the stock is trading at 96, 97, 100, your order does nothing.
It's just waiting.
It lives on the server, invisible to other traders. It's a sleeping sentry.
Then bad news hits. The stock drops. It touches 95.
Boom. The trigger price is hit. The order wakes up. It is now released into the live market. Now, here's where the second price matters. If you used a stop-loss market SLM order, it wakes up and becomes a market order. It sells at whatever price it can get.
Which could be 94, 93. Or if it's a crash, 80.
Exactly. In a flash crash, an SLM order guarantees you get out, but it doesn't guarantee the price. You get crushed on the slippage.
So the alternative is a stop-loss limit, SLL.
That gives you more control, but it carries a different risk. You set a trigger at 95 and limit it, say, 93. When the price hits 95, your order wakes up and becomes a limit order to sell at 93.
So it won't sell for less than 93.
Correct. But what if the price gaps down? What if it goes from 95 straight to 90 in 1 second?
My order doesn't get filled.
Then your limit order at 93 sits there unfilled. The market is at 90. You are still holding the stock. You didn't get out.
That is a nightmare scenario. I'm watching the price tank, and my stop-loss didn't execute because the market jumped right over it.
It is the classic trader's dilemma. Stop-loss market guarantees exit but risks a bad price. Stop-loss limit guarantees a price but risks no exit. You have to choose your poison based on the volatility of the stock.
There are also time conditions, day orders or standard. But what about IOC? Immediate or cancel? Who uses that?
Immediate or cancel. It's exactly what it says on the tin. Fill whatever you can right this second and cancel the rest. Imagine a large institution wants to buy 100,000 shares, but they don't want to leave a huge buy order sitting in the book for everyone to see.
Because that would signal demand and push the price up. Other people would front run them.
Exactly. So they fire an IOC order, buy 100,000 at 100. The system checks the book. Only 20,000 are available at 100. It buys the 20,000 instantly. And the remaining 80,000 request. It vanishes. It's canceled.
It's like a ninja strike. Get in, take what's there, disappear.
Perfect analogy. It leaves no footprint for other traders to analyze.
Speaking of footprints and preventing chaos, let's talk about price bands. The invisible walls, the text mentions operating ranges.
Right. The exchange doesn't want the market to move 50% in 1 second because someone made a typo A fat finger error. So they set bands. For futures, it's typically 10% of the base price. You cannot place an order outside that range. The system just rejects it.
But there is a very important update in the source material here, a SEBI circular from May 2024 regarding dynamic price bands. This seems to be a reaction to some manipulation, right?
It is. In the past, these price bands were flexible. If a stock hit the 10% upper circuit and there were still buyers, the exchange would expand the band to 15%, then 20%.
To let the price find its true level.
In theory, yes. But manipulators found a loophole. A small group of traders could trade among themselves to push the price up, hit the limit, force the band to expand, and keep pumping the stock.
The classic pump and dump.
Exactly. So SEBI tightened the screws. The new rules for flexing the price band are much stricter. It's not automatic anymore. To expand the band, you now need substantial proof of genuine market depth.
What does that mean in practice?
The circular requires 3 things. First, a minimum of 50 trades.
Okay.
Second, at least 10 unique client codes, so 10 different people trading. And third, at least 3 distinct brokerage firms on each side of the trade.
Wow. So a single whale or a operator using one broker can't just push the limit up alone.
No. You need consensus. You need distinct players involved. And if the criteria aren't met, the stock goes into a cooling off period.
A timeout.
Yes. Trading is paused. The market takes a breather to digest the information. This prevents panic buying or panic selling from spiraling out of control instantly. A very smart evolution of the safety net.
Okay, we've covered the mechanism and the orders. Now let's talk about the merchandise. I think a lot of people assume that if a stock is listed on the exchange, you can trade futures on it. But that's not true, is it?
Not at all. There are thousands of companies listed on the NSE and BSE, But only a handful, around 180 to 200, usually are in the derivative segment. It is an exclusive club.
The VIP list, why is it so exclusive?
Because derivatives are leveraged instruments. They're high risk. If you allow futures trading on a tiny, illiquid penny stock, it becomes a playground for manipulators.
I see.
They could corner the market, squeeze the shorts, and bankrupt retail traders. The exchange needs to ensure the stock is robust enough to handle that kind of pressure.
So how does a stock get into the club? What's the vetting process?
It's rigorous. A stock has to perform well for a continuous period of 6 months. First, rank. It has to be at the top 500 in terms of average daily market capitalization and average daily turnover.
Okay, so it has to be big and active, no tiny companies.
Right, but then we get into the technical metrics. The quants take over. The most interesting one is MQSOS.
Median quarter sigma order size. That is a mouthful. Unpack that for us.
Let's break it down. Sigma in finance usually refers to standard deviation, a measure of volatility. Quarter sigma implies a specific fraction of that volatility, but in plain English, MQSOS is a stress test for liquidity.
A stress test.
It asks, can I place a significantly large order, specifically an order size of R75 lakhs, without causing the stock price to jump wildly?
Okay. So if I try to buy 75 lakhs worth of a stock and my order alone pushes the price up by 5%.
Then the stock fails. It's too fragile, it's too thin. A true derivative-grade stock should be able to absorb a 75 lakh rupee order with barely a ripple in the price. The threshold is that the MQSOS must be greater than Rs 75 lakhs.
That is a great way to visualize it. It's a shock absorber test.
Exactly. Then there is the market-wide position limit, or MWPL. This has to be greater than Rs 1,500 crores. This basically measures the free float, the shares held by the public, not the promoters.
So it ensures there are enough shares out there to trade.
Right. It ensures there are enough actual shares out there for people to bet on. If the promoter holds 90% of the company, the free float is too small, and the stock can be cornered easily.
And lastly, delivery value.
Yes, average daily delivery value in the cash market must be over Rs 35 crores. This is the is it real test. Turnover is easy to fake with day trading. I buy, I sell, I buy, I sell. High volume, zero commitment.
Right.
Delivery means people are actually buying the stock and taking it home. They are holding it in their demat accounts. It proves genuine investment interest, not just speculation.
So you pass the test, you get into the club, you pop the champagne, but you can get kicked out too, right?
Oh, yes. It's like a sports league with relegation. If you play badly, you get demoted back to the minor leagues. This is governed by the Product Success Framework, or PSF.
What gets a stock kicked out?
Apathy. If the market stops caring about the stock. Specifically, if fewer than 15% of active trading members are trading it, or if trading doesn't happen on at least 75% of the trading days, or if the average daily turnover drops below and say 75 crores.
So if nobody wants to trade the future, the exchange just shuts it down.
Exactly. It's expensive to maintain these contracts. If the liquidity dries up, it becomes dangerous for everyone.
What happens if a stock gets the boot? Do the contracts just vanish overnight?
That would be chaotic.
Oh, no.
No, they stop issuing new contracts. The existing ones, current month, next month, far month, are allowed to run until they expire. But once the last one dies, that's it. The stock is back to being cash market only.
And there's a penalty box.
A 1-year ban, a mandatory cooling off period before it can even try to reapply.
Harsh. Now, quickly on indices, Nifty and Bank Nifty, do they have similar rules?
They do. The most critical is the diversification rule. No single stock can have more than 25% weight in the index. This is to prevent a one-man show. You don't want the entire Nifty 50 to crash just because one company had a bad earnings report.
And the 80% rule?
Right. The stocks that make up the index. 80% of them, by weight, must be individually eligible for derivatives trading. You can't build a derivatives index out of stocks that aren't good enough to have derivatives themselves. It ensures the foundation is solid.
Let's move to the next section. This is the one that involves a calculator. Corporate actions. One of the biggest fears new traders have is, what happens if I hold a call option and the company announces a bonus share? Usually when a bonus happens, the stock price drops, right?
Yes. In a 1-for-1 bonus, the stock price roughly halves.
So if I have a call option with a strike price of 1,000 and the stock drops to 500 because of a bonus, my option is worthless, I lose everything. That feels incredibly unfair.
It would be unfair. And that's why the math of fairness exists. The guiding principle of the exchange is simple. The value of your derivative position should not change just because of a corporate action. You shouldn't lose money, and you shouldn't gain money.
How do they achieve that? Let's walk through the bonus issue example.
Okay. Let's say you have One lot of ABC Corp. The lot size is 1,000 shares. The strike price is Rs 1,000. So the notional value is 10 lakhs.
Okay.
The company announces a 1-for-1 bonus. On the X date, the stock price halves to Rs 500.
Right. My option is way out of the money.
The exchange steps in and does two things. First, they adjust the strike. They divide your strike price by the adjustment factor, which in this case is 2. So your 1,000 strike becomes a 500 strike.
Okay, so the strike moves down with the stock. That makes sense.
Second, they adjust the lot size. They multiply your lot size by the adjustment factor. So your lot of 1,000 shares becomes a lot of 2,000 shares.
Let's check the math. Before, 1,000 shares times 1,000 strike equals a notional value of 10 lakhs. After, 2,000 shares times a 500 strike equals a notional value of 10 lakhs.
Bingo. The structure of the contract changed, but the total value you control is exactly the same. You are neutral. You're made whole.
That's elegant. Now, what about dividends? This is trickier because dividends are cash leaving the company.
Yes. When a company pays a dividend, the stock price drops by about the amount of the dividend. The exchange has a threshold rule here, the 2% rule.
Explain that.
They compare the dividend amount to the market price of the stock. If the dividend is ordinary, meaning less than 2% of the market value, the exchange does nothing.
Nothing. But the stock price drops. Call option holders lose a little bit.
They do. But the market considers this noise. It's a small amount. The market is expected to price it in naturally. It's part of the game.
Okay.
However, if the dividend is extraordinary 2% or more of the market value, that is significant. That moves the needle.
So if a stock is RS 100 and they declare RS 5 dividend, that's 5%. That's extraordinary.
Correct. In that case, the exchange intervenes. They will subtract the dividend amount, the RS5, from all the strike prices of the options.
All of them?
All of them. A 100 strike becomes a 95 strike. A 110 strike becomes a 105. This protects the put and call holders from a massive artificial jump or drop caused by the cash payout.
It's all about maintaining the status quo of value. We've talked about how trades happen and how fairness is maintained. But fairness isn't free. We have to pay to play. Section 5 covers trading costs. And there are two types, the ones you see on the bill and the ones you don't.
The visible and the invisible. The visible costs are straightforward. Brokerage, that's what you pay Zerota or Upstocks. But then you have the statutory charges, the taxes, and specifically the STT, Securities Transaction Tax.
This is where the devil is in the details.
It is, and it affects your strategy. For futures, the seller pays 0.02%. The buyer pays nothing. But for options, it gets complicated. If you sell an option, trading the premium, you pay 0.1% on the premium value.
Which is usually a small number, manageable.
Right. But if you exercise an option, meaning you hold it until expiry and actually take delivery of the shares, the tax rule changes completely.
How so?
The purchaser pays 0.125%, but not on the premium, on the settlement price.
Whoa. Wait, the settlement price is the full value of the stock, not the option price.
Yes. If you exercise a call option on Reliance, you pay tax on the full value of those Reliance shares, not just the tiny premium you paid for the option.
That is a massive gotcha.
It catches so many traders off guard. They hold a seemingly profitable option to expiry, and then they see the tax bill and realize they made a loss. It's a painful lesson.
Always check the exercise costs. Now, let's talk about the ghost in the machine. The invisible cost. Impact cost. We touched on this with MQSOS, but let's define it for the trader.
Impact cost is the true cost of liquidity. We often think liquidity just means high volume. But true liquidity is the ability to buy or sell a large quantity without moving the price against yourself.
The source material uses a bid-ask spread example. Let's walk through that.
Imagine the ideal price of a stock is the average of the best buy and sell price. Because buyer is at 16.60, the best seller is at 16.80, the ideal price is 16.70.
Okay. The midpoint.
Right. But if I want to buy right now, I can't buy at 16.70. I have to pay what the seller wants. I pay 16.80 a year.
Yeah.
Exactly. You pay 10 paisa more than the ideal price. That 10 paisa is your impact cost. Now, for one share, who cares? But imagine you want to buy 50,000 shares.
Okay.
The seller is 16.80, only has 500 shares. You buy those. The next seller is at 16.85. You buy those. The next is at 16.90. You buy those.
I am eating through the order book, and my average price is climbing with every trade.
By the time you fill your entire order, your average buy price might be 16.95. You have moved the market price up by your own demand, That gap between the 16.70 ideal price and your 16.95 actual price is your impact cost.
It's like walking through water. The faster you try to move or the bigger you are, the more resistance or cost you feel.
Perfectly stated. And this is why institutional investors obsess over this metric. For them, a 1% impact cost on a billion-dollar trade is a $10 million loss before they've even held the position for a second.
Speaking of institutional investors and billion-dollar trades, let's talk about the entities that care about impact cost the most, the machines. Section 6, algorithmic trading.
This is where the market has fundamentally changed. Algo trading isn't just a tool anymore. It's the dominant species in the ecosystem.
Define it for us. What is it, really?
A simple definition. It's trading using automated, pre-programmed instructions. The three variables are price, timing, and volume. If price crosses moving average 50, buy 100 shares. That is an algorithm.
It removes the emotion. The computer doesn't get scared. It doesn't get greedy. It just follows the rules.
And it's fast, unbelievably fast. SEBI categorizes them based on speed, low-frequency trading. These are basic automation tools. Maybe they execute a few trades a minute. The rule is fewer than 10 orders per second.
10 orders a second is still pretty fast for a human.
For a human, it's impossible. For a computer, it's a nap. Then you have high-frequency trading, HFT. These do more than 10 orders per second. We are talking about thousands of orders in the blink of an eye.
And the regulation is different for them.
Drastically. High-frequency algos need a unique exchange ID. They require strict registration and audits, because if an HFT algo goes rogue, it can fire off thousands of bad orders in milliseconds. It can crash the market.
Now, there is a very specific warning in the text about unregulated platforms. I see ads for these all the time on YouTube. Use our secret algo, get 10% monthly returns.
This is a critical public service announcement. Listen closely. SEBI is extremely strict about this. The API, the pipe that connects a computer to the exchange, cannot be open to just anyone. It must be mapped to a broker-approved static IP address.
So I can't just write a Python script on my laptop at a Starbucks and plug it directly into the exchange.
Absolutely not. And here's the other rule. You cannot change the logic on the fly. If your algo says buy on moving average cross, you can't just log in midday and change the code to buy on RSI breakout.
Why not?
If you change the logic, that is effectively a new algo.
Yeah.
It needs to be re-registered and reapproved by the exchange. It's to prevent bait and switch. To prevent someone from taking a safe, approved strategy and secretly turning it into a high-risk gambling machine without any oversight.
We've covered the tech, the speed, the fairness, but we live in a digital world and digital things crash. We've all had that moment where the internet goes down, but what happens when the broker goes down? You're in a trade, the market is crashing, you try to open your app, and it just spins. Service unavailable. Panic sets in.
This is the nightmare scenario, and it has happened. That is why we now have IRRA. Investor Risk Reduction Access.
IRA. It sounds like a superhero organization. What does it actually do?
It acts as a safety net provided directly by the exchanges, by the NSE and BSE. If a trading member, your broker, faces a massive technical glitch, they inform the exchange. The exchange then triggers IRA.
And the investors get a notification.
Yes, you, the client, get an SMS or email with a link to log into the IRA platform. But and this is vital, IRA is not a trading platform.
Yeah, so I can't buy the dip. If the market's tanking and I think it's an opportunity.
No, you cannot take new positions. IRRA is an emergency exit only. You can only close open positions or cancel pending orders. It is designed solely to stop the bleeding and get you out of the market safely.
That is a huge relief to know. So if my broker goes dark, I'm not trapped. What about if the exchange itself goes down, if the NSE pulls the plug?
That is where interoperability comes in. The clearing corporations are linked. If the NSE goes down completely, you can technically hedge your positions on the BSE if the products are correlated.
Like buying Nifty futures on NSE and selling Sensex futures on BSE?
Exactly. Or even trading the same stock futures if they are listed on both. The regulations are strict here. If an exchange fails, they have to inform the alternative venue and SEBI within 75 minutes.
75 minutes.
And the alternative venue has to take over operations within 15 minutes of that intimation.
So there is a rigorous disaster recovery timeline. It's not just, we'll fix it when we fix it.
No, the clock is ticking the moment the glitch happens. The market hates uncertainty more than anything else.
We have covered a massive amount of ground today. We started with the invisible engine, the matching algorithm. We looked at the VIP club of eligible stocks and the relegation zone. We crunched the math of fairness for corporate actions. We analyzed the hidden impact costs and the visible taxes. And we finished with the algos and the disaster recovery.
It really highlights that the trading mechanism isn't just pipes and wires. It's a set of rules designed to balance three competing forces: speed, fairness, and risk.
And as we wrap up, I want to leave our listeners with a thought. We started by talking about the transition from open outcry humans shouting to high-frequency algorithms doing thousands of trades a second.
It's a shift from biological speed to silicon speed.
Exactly. And we talked about impact cost, the cost of liquidity. Here's my question. As AI and deep learning models become the dominant buyers and sellers, does the concept of impact cost change? If the counterparty to your trade is an AI that can predict your order flow before you even finish typing it, are you paying for liquidity or are you paying a predictability tax?
That is a provocative question. If the machine knows you're going to buy before you do, the price will always move against you just enough to extract the maximum value. We might be moving toward a market where human reaction time is the biggest inefficiency of all.
Are we the slow poker players at the table?
I think we might be. The challenge for the modern trader isn't beating the machine at speed, it's understanding the rules of the game so you don't get run over by it.
Understanding the mechanism is just as important as predicting the price.
Couldn't have said it better myself.
That's it for this deep dive into the invisible engine of the market. Thanks for listening, and we'll catch you on the next one.
Happy